With taxes being the single largest expense most people have throughout their lifetimes, there's no shortage of taxpayers looking for a way to cut down on their liability. After all, who enjoys paying income tax, property tax, sales tax, excise tax, and more, leaving them with just a portion of their total income? When you earn $60,000 per year and end up spending $30,000 on taxes, it can be frustrating. Thankfully, there are some ways that the average person can legally reduce their tax liability so they can keep more of their hard-earned dollars. You might find these ideas to be beneficial to your financial situation, so you're able to reduce your tax bills. If you enjoy videos about money, personal finance, and investing, all topics that will help you better your financial future, consider subscribing to the channel and hit the notification icon to be notified of new videos. If this video is helpful, make sure to hit the like button. Health Savings Account. Medical expenses can be a significant cost for people, especially as they age, and the expenses can be unpredictable if health issues arise. If you have a high deductible health care plan, you might be able to contribute to an HSA or health savings account. This is a tax-exempt account that you can stash money in to save for medical expenses. Contributions are tax-deductible and withdrawals are also tax-free, as long as you use the money for qualified medical expenses. The investment gains are also tax-free, and the funds can be invested in a low-cost index fund, so you don't need to worry about inflation eating away at your savings, especially if the money goes unused for a long period of time. Eligible expenses would be a new pair of eyeglasses, programs to help stop smoking, hearing aids, or modifications done to your home that are necessary due to medical complications. If you have self-only high-deductible healthcare coverage, you can contribute up to $3,500 in 2019. If you have high-deductible coverage for your family, the contribution limit doubles to $7,000 in 2019. Your employer may offer an HSA, so be sure to ask your Human Relations Department about it. If not, you can open one up yourself at a bank or credit union, either online or locally. HSAs are nice because there's no deadline to withdraw funds, like in some retirement accounts. However, if you're under 65 years of age and you decide to withdraw the money to fund a family vacation or other non-medical expense, the money becomes taxable income and could be subject to an additional 20% penalty. Once you turn 65, the money can be used for a new car if so desired, but the money will be taxed as ordinary income. If you choose to use it for medical expense, it will be tax-free. Once you reach age 65, you will avoid the 20% penalty, but you will pay income taxes on the distributions not used for medical expenses, just like an IRA. But still tax-free for the rest of your life for eligible medical, dental, and vision expenses. You have until the April tax deadline to contribute for the previous year. Flexible Savings Account. An FSA, or Flexible Savings Account, is similar to an HSA in that it can be helpful for reducing taxable income by using it for qualifying medical expenses, but the main difference is that it must be set up by your employer, similarly to a 401k. The money will be withdrawn directly from your paycheck and dedicated to this account. As with a 401k, the account can be funded by the employer, employee, or a combination of the two. The limit in 2019 is $2,700, but the money will need to be used during the calendar year for medical and dental related expenses, but the amount the employer contributes doesn't generally count towards the personal $2,700 contribution limit. Examples of qualifying expenses include acupuncture, flu shots, hearing aids, x-rays, mileage to and from eligible health care, and other items needed to meet your health policy's deductible. To access the money in this account, you can usually use a debit card for the expenses or simply submit the receipts to the administrator of the account. Using a debit card is probably the easier way to go, but remember to keep records and receipts to prove that the expenses were in fact eligible. The biggest downside to a flexible savings account is that if you end up having a healthy, issue-free year and the money isn't used for medical expenses, the money left at the end of your benefit period may no longer be available to you. The IRS has ruled that in some cases, up to $500 of your HSA may be carried over into the next year. Employer 401k. If your employer provides a 401k match, This is a great opportunity to take advantage of free money, which you would otherwise not receive, usually 3 to 6% of your salary. 401k accounts must be offered and set up by your employer, but the maximum contribution limit is relatively high for those able to contribute more, up to $19,000 for those under 50 and up to $25,000 for those over 50. The biggest advantage to a 401k is the employer match, if offered. Another advantage to this type of retirement account is the tax deduction for the year that you contribute. A disadvantage is that you have little control over which investments are chosen, possibly resulting in higher cost funds. Typically, 401ks only offer a small selection of funds. You won't be able to withdraw before age 59.5 without penalty, and you're required to start withdrawing at age 70.5, even if you have another income source funding all of your expenses. Your distributions will be taxed as ordinary income. Traditional IRA. A traditional IRA is an individual account that you may open with an advisor, or you may do so yourself online. If you're offered a 401k match, it's probably worth it to contribute at least enough to get the maximum match from your employer, then invest anything surplus in an IRA. These funds are often less expensive with more choices, including a nearly endless selection of index funds, individual stocks, and bonds. For individuals, the limits for 2019 are $6,000, and if you're over age 50, you're allowed a catch-up contribution totaling $7,000. Individual retirement accounts offer the benefit of being able to choose your investments, where 401ks typically only offer higher-cost mutual funds, which can eat away at your portfolio over time. You'll probably receive a tax deduction when you contribute, but limits are low compared to a 401k. You won't be able to withdraw before age 59.5 without penalty, and just like with a 401k, you're required to start withdrawing at age 70.5, regardless of whether or not you need the income. If you've done a great job planning for retirement and you don't need to withdraw from this account due to other income sources, you will need to do so anyway. Your distributions will be taxed as ordinary income. Roth IRA. Roth IRAs provide the same investment selections as a traditional IRA, except there is no current year tax deduction. That might not seem very enticing at first, but as a result, they are not subject to any income tax when they are drawn upon during retirement years, which is a nice benefit, especially for those who don't need the current year tax deduction. Everything you withdraw during your retirement will be completely tax-free. As with a traditional IRA, you will have a wide selection of investments of which you can purchase. For 2019, $6,000 is the maximum contribution. For those 50 or older, the max jumps to $7,000. With this account, your contributions aren't tax deductible, but your earnings will go tax-free and there are less restrictions when it comes to withdrawals. With a Roth, you won't be subject to mandatory distribution at any age. If you win the lottery or receive a large inheritance and no longer need the money in this account, you can leave it there and allow it to continue growing instead of being forced to take it out. COVERDELL ESA. The cost of college can be very high for many parents, especially if they have more than 1 or 2 children. Saving taxes when it comes to paying for college can be very helpful. ESAs, or education savings accounts, allow your money to grow and be withdrawn tax-free when used for education expenses. The contributions, however, are not tax-deductible, so that money will be taxed during the year in which it was earned. With a COVERDELL ESA, parents can contribute up to $2,000 every year for each beneficiary, so it pays to start early when planning for college funding, especially since contributions can no longer be made once your kids turn 18. Contributions to a COVERDELL ESA phase out if you make more than $95,000 or $190,000 for joint filers. Investment choices are nearly endless with these accounts, making it possible to purchase individual stocks or funds if so desired. If you want to purchase some shares of Disney stock for your children, this plan allows you to do that. When you're ready to start taking distributions, the money can be used for tuition and fees, books and supplies, computers, and sometimes room and board. The funds can even be used for some elementary school, middle, and high school expenses. If your children don't need the money for education-related expenses, you can withdraw the money, but the gains will be taxed at ordinary income rates, and it may be subject to a 10% penalty. Invest in real estate. Rental property is known to provide excellent tax benefits for investors because the government needs people to provide housing for those who are unable or unwilling to own. The cost of repairs, maintenance and upkeep, utilities and management expenses are all tax deductible. You can even deduct travel expenses associated with the property, such as gas and mileage to and from visits. Mortgage interest is deductible, and the property can be depreciated based on a 27.5-year schedule. The IRS allows investors to depreciate the property because the building has a useful life to it before everything will have been replaced. In theory, items such as the roof, windows, plumbing, appliances, and heating and air conditioning systems will all have to be replaced over that time frame, even though some items will not need to be replaced, such as the foundation and framing, provided there are no major issues. For example, if a property, excluding the land, is worth $275,000, $10,000 per year will be tax deductible, which is a fairly sizable amount. Many people love the tax deductions offered through investing in rental properties, which are hard to match when investing in paper assets such as stocks, even when they're purchased within tax-efficient accounts. Hire a CPA. Getting yourself a knowledgeable, certified public accountant is a good idea, particularly if you have a complicated tax situation, such as a business and investment income, or unusual tax deductions. If you only earn W-2 income and have very few deductions, it might be reasonable to attempt filing your own taxes, but then you risk making costly mistakes or being audited down the road. If you're taking advantage of the majority of these efficient tax strategies, working with a professional will likely be worth the money. Many people will tell you that the cost of hiring a CPA will pay for itself and much more. They are experts in their field after being required to complete a 5-year business degree, pass the CPA exam, and being continually required to complete more and more education to ensure they fully understand the tax code. Everyone's situation is different, which is why it's important to talk with a professional that can address your personal circumstances. It's helpful to work with a CPA throughout the year to keep your tax planning in check, so there are no surprises when tax season arrives. Every bit you can save on your tax liability will be money that you can hold on to instead of paying more than your fair share. If you're able to reduce your taxable income by $10,000 and you're in a 30% tax bracket, that will leave you with an extra $3,000 in your pocket that can be used to put towards your future or towards a family vacation. No one wants to pay more than they're legally required to, so taking the proper steps throughout the year will help you be prepared to file your taxes and avoid any major surprises, like owing much more than originally expected. Everyone's situation is different. For example, someone who's predicting a much higher income during retirement will want to use a Roth IRA instead of a traditional, and someone who's predicting a lower taxable income during retirement will probably be better off using a traditional IRA. These ideas might not work for you, which is all the more reason to consult a professional. With a little diligence, it's easy to take advantage of various tax-saving strategies to legally lower your obligation. No one wants to send the government any more hard-earned money than is absolutely necessary, and in fact, the IRS encourages us to take advantage of these strategies. With death and taxes the only two certainties of life, why pay more taxes if you don't need to?